Understanding liquidity is absolutely essential if you want to succeed in the day trading space. So in today's video, I'm going to be defining and going over the concept of internal range liquidity. In my last video of this series, I went over external range liquidity and a lot of basics about swing highs and swing lows. In today's video, I'm going to talk about why fair value gaps are so important to understanding liquidity and how you can absolutely bank using them in your system. So like I said, internal range liquidity, the main version of it that you're going to find relevant is fair value gaps. And I'm just going to take a moment to remind you guys about how trends work in the market. So a lot of you guys have likely been taught about uptrends, right? We'll have a swing low, a swing high, then we'll have some pullback inside of the previous range, and then we'll reach for that old swing high and likely exceed it, right? If we're in an uptrend. And we'll kind of just keep doing that process. That's why it's a squiggly line. So the reason stocks don't go straight up is because of internal range liquidity, right? So I already talked about external range liquidity, right? Swing highs and swing lows. But you have to understand internal range liquidity because this can help you easily position to actually catch the entire part of that next move instead of just buying once the swing high or swing low is broken in a downtrend, right? Because a lot of people are going to say, let me buy when we break that past swing high so I can catch the next leg up. What if you were able to buy somewhere down here in the midpoint of that previous range and you could catch about twice the move? So that's where internal range liquidity comes in, and that's why it's so important. So now for you guys who don't know, a fair value gap is a 3-candle pattern, and it's basically drawn out as a box between the wick high on the left candle and the wick low on the right candle. And what you really want to look for, because I think a lot of people kind of get confused and try to draw fair value gaps on every tiny little gap they see. So what you want is something obvious, where one of my favorite YouTubers, Dodgy's DD, puts it really well. He says, if you can scooch back and see the candle, the impulsive fair value gap candle from several feet away, then it's probably worth marking. So this one right here is a really good example, right? You have this impulsive candle in between two others that are nowhere near as big, and this creates an imbalance in the market. And when it's traded back into, it's often going to provide a supportive level for the market where a lot of buy orders have been left unfilled inside of this, right? So you can see on an uptrend, what do? Well, first of all, this was the April bottom. So this is kind of the start of an uptrend. So we have a higher low first, then we create this fair value gap. We pull back into it. Then what do? We make another move up. And what do we have? Let's delete these past drawings because now on this next move up, we have created another fair value gap. This is a bullish gap. Now, I know I said 3-candle pattern and this is technically 4, but these 2 candles, I count them as one fair value gap because there's really no wick here. So you can kind of just count them as one. Now what happens? Well, exactly what you'd expect if you've been paying attention. We create this fair value gap, we move up, we chop around a little bit, then we come back down, right? We never make a lower low, we never take out the old swing low, but we do retest this internal range liquidity. So once again, a lot of people, if they don't understand fair value gaps, might just wait until we break this old high to long because we're confirming trend continuation, which would have worked kind of, but you would have missed a lot of this move. Instead, what you want to do is develop a system that allows you to get in early once these higher time frame fair value gaps are retested, right? So we have this really obvious one. We come back down, completely just moon back to the upside because we traded into that gap. Look, once again right here, and it will keep going on every uptrend. You'll see this, right? We create an imbalance, we trade back into it, we make a low inside of it, then come back up. Oh, look, what happens again? Create an imbalance, trade back into it, continue up, right? And it just keeps on happening over and over and over again. And that's exactly how uptrends work, because the market needs to move back to internal ranges where imbalances were left to take care of unfinished business, to then only generate the buy order power, the buying power, the buy pressure, I guess I should say, to really start to exceed the previous swing high in an uptrend. Real quick, if you're enjoying this video, make sure to like and subscribe so you can catch the rest of this series. I'm going to be going over a ton of concepts to help you guys fully understand liquidity. And also, after you check this one out, make sure to watch the last one if you haven't yet. Enjoy the rest of the video. So now right here, this is a bearish example. Look at this. We have this swing low right here. We take it out. We create a bearish fair value gap. As you can see, this candle is very impulsive, way bigger than the ones to the left and right of it. So you draw the box from the wicks. But instead of going straight down, because no downtrend can ever go straight down and no uptrend can ever go straight up, we have to rebalance, right? So seeking out internal range liquidity is called rebalancing, right? We're rebalancing into the imbalance that we created, and then we're coming back, right? And we're doing it all over again. So that's a perfect example of a bearish fair value gap putting in some work. You have more examples here, right? We have this impulsive move down. We trade back up into it. We rebalance into it. We reject. We start to sell off again, right? And you can just keep finding examples of these. Now, with the downtrends, we don't have any great actual downtrends lately because we've kind of just been chopping in a range for months. So sometimes you won't see them working as, not working as well, but you won't see them as common. But right here, if you look when we actually started this mini bear market from, the spring and the winter, we had this fair value gap play out. We had many fair value gaps that were completely holding and completely being respected, right? And we're never being closed above. So it's very important to understand fair value gaps, like I said. It is the most important concept in all of ICT trading, I think. Well, because it relates to liquidity, right? Liquidity in general is by far the most important concept in trading in my mind. And fair value gaps are liquidity. They're not always considered it because people always think of liquidity as swing highs and swing lows. But fair value gaps are also a form of liquidity, right? They're internal range liquidity. So a lot of times what you can do is you can play these rebalances. You can either try to target them. So say we're at a swing low point, we sweep out some liquidity, some external sell side. If you guys watched the last video, you know what that is. Say we sweep some of that out, and then you say, okay, look, we just left this massive bearish 4-hour gap here. We probably need to rebalance into that, right? So you try to trade longs, and then you exit once we rebalance into that. That's a good strategy. Or you could try to get into the early next leg of the move by watching when the rebalance stops happening, right? So when this starts showing weakness, you could try to get in for this move, right? You could have done it up here too, right? We have this bearish fair value gap. We wick back up into it. You can try to catch that rebalance and then short down to the new low that you would expect because trends continue oftentimes. So fair value gaps, very, very important, right? They're internal range liquidity, IRL, right? In real life, no, internal range liquidity. That is what you need to be thinking of it as. And like I said, very important concept. Liquidity as a whole is going to make you a much better trader if you have a deep understanding of it. And a lot of people just think of swing highs and swing lows. Like I said, you need to be also acknowledging internal range liquidity because it is so, so important to be able to get what a lot of people call bottom ticks, top ticks, sniper entries, whatever you want to call it. You need to understand not only external, but internal as well. Now, you guys all know how I've been talking about how good liquidity is to target, right? If you understand liquidity, you can use it as a target. Now that concept is called draw on liquidity, and I'm going to go over that in the next video, and I'm going to go over my favorite types of it that give me the highest conviction trades possible every single day whenever I find them. So like I said, stay tuned for the next episode, draw on liquidity and my favorite types of it. And yeah, hopefully you guys enjoyed the video. Make sure to click the link in the description to join my free trading Discord. No credit card, no email, no nothing. Especially if you're still watching, you're probably serious about trading. So I'd love to have you in my community. And with that being said, I appreciate you all for watching. I'll catch you in the next one. Peace.